Okay, let's dive into this. Imagine sitting in a boardroom, right? You're tasked with deploying $10 million into peer-to-peer loans. And the catch is, you can't lose your shirt. In this explainer, we're going to completely crack the code on the Lending Club mystery. We're talking about moving from just basic data prediction to a totally game-changing portfolio strategy. It's going to be wild. Now, this right here is the absolute core dilemma. It's the central mystery we're trying to solve. Is it actually possible to profitably invest in peer-to-peer loans while at the same time protecting ourselves against catastrophic risk? I mean, when you're dealing with peer-to-peer lending, you aren't dealing with massive corporations with safety nets. You're dealing with everyday individuals. So that risk of default, it is incredibly real. And the stakes? We're looking at a $10 million investment budget. So how on earth do we confidently put 10 mil on the line in such a volatile market? Well, naturally, our first instinct is to try and predict the future. Like any good detective chasing a lead, the project initially followed the most obvious path: predictive analytics. The idea was to look at things at the micro level, basically asking, can we predict if this one individual loan, let's say John Doe's loan, is going to default? And if it does, how much are we going to lose? We threw the absolute heavy hitters of machine learning at this: logistic regression, decision trees, even complex neural networks. And the absolute best models achieved an AUC score of roughly 0.70. Now, in the data science world, hey, that's better than a coin flip. It's enough to make a statistician smile, for sure. It feels like a solid lead. But, as we very quickly discovered, betting $10 million on a 0.7 AUC is a complete trap. So, the crucial point is this: individual loan prediction is simply not enough, period. It is a really tough business reality to accept when your models are technically performing decently, but an AUC of 0.70 still leaves a massive, massive margin for error. Even the absolute best predictive models struggle to catch every single bad loan without generating this huge wave of false positives. If you're relying purely on predicting individual behavior, you are completely exposed. Literally, all it takes is a fast-paced wave of unexpected defaults, the loans your model swore were perfectly safe, to completely wipe out those tight profit margins. Picking loans one by one, it's essentially walking through a minefield blindfolded, just crossing your fingers and hoping your model just right every single time. Realizing this micro-level approach was, frankly, doomed, we knew we needed a massive strategic breakthrough. We had to completely change our entire perspective. So we're moving away from predictive analytics, evaluating those loans one by one, which we just established as way too risky. Instead, we are pivoting over to prescriptive analytics. Rather than asking, is this one specific loan going to default, we're stepping back. We want to look at the macro picture. We want to group thousands and thousands of loans into distinct profiles. We aren't just predicting anymore, we're prescribing a strategy based on broad, historical group behavior. Now, to actually pull off this grouping, the project utilized k-means cluster analysis. If you haven't played around with it, it's this incredibly powerful algorithm that essentially takes a massive, chaotic sea of data points and organizes them into really neat, understandable buckets. In this case, it grouped thousands of Lending Club loans into exactly 5 distinct borrower profiles. How did it do it? By zeroing in on similarities in key financial metrics, stuff like the borrower's income, the total loan amount, and the assigned interest rate. By categorizing everyone into these 5 clusters, we unlock something huge. We can finally map out the historical default rates and the specific loss fractions for each of these distinct profiles. We finally have the concrete, hard parameters we need to actually start simulating the future. Let's move to and see how this builds into our actual investment strategy. With our parameters all set, it's time for a major stress test. Step 1, locking in that $10 million investment budget we've been talking about. Step 2 is testing a standard, super conventional strategy, an equal weight diversification approach. Basically, we take that $10 million and slice it up evenly, putting exactly $2 million into each of the 5 borrower clusters. Makes sense on paper, right? Well, step 3 is the reality check, a Monte Carlo simulation. And we didn't just run it once or twice, we simulated the future 100,000 times. This lets us see exactly how this equal weight portfolio performs across literally every possible market crash, boom, and bust. And wow, here is the brutal reality of that simulation: a $250,000 expected loss. Ouch. We took $10 million, we diversified it perfectly evenly across the market, just like the textbooks say, and the simulation tells us we are actively destroying value. Can you imagine sitting in that boardroom and having to present this number? It is an absolute disaster scenario for any investment committee. If we had simply followed standard conventional wisdom, diversifying our assets evenly across the board, we would be walking right off a financial cliff. So, why did this completely naive, equal weight strategy fail so spectacularly? Well, the simulation data points the finger directly at specific groups. Clusters 3, 4, and 5, which represent our high balance and high risk borrowers, they fall entirely below the break-even line. They aren't just underperforming, they are actively bleeding money. The high default rates within these 3 specific clusters create this massive financial drag on the entire portfolio. They essentially act like a toxic anchor. Even though clusters 1 and 2 are much safer borrowers, are diligently generating solid returns, the sheer weight of the losses from 3, 4, and 5 just completely erases those profits. This proves definitively that in the wild west of peer-to-peer lending, naive diversification simply does not work. Okay, so we're looking at a broken strategy and a projected $250,000 loss. We desperately need a rescue plan. Our new goal? Maximize the Sharpe ratio. In finance, you already know this is the holy grail, squeezing out the absolute highest possible return for the lowest possible risk. What we need to do is feed all of our simulation data into an optimizer and let the math objectively tell us exactly how to allocate that $10 million to hit the best possible Sharpe ratio. We need an aggressive solution here, completely unburdened by this old-school traditional idea of just being evenly balanced. And this brilliantly illustrates an incredibly aggressive recommendation straight from the optimizer. The math literally dictates that we strip funding entirely away from the toxic clusters. I mean, $0 allocated to clusters 3, 4, and 5. None. Instead, the model demands we push a massive 86% of our entire budget into cluster 1. Now, these are our safest, albeit lower yield borrowers. Then we take the remaining 14% and allocate it over to cluster 2. That piece acts as a slight return diversifier, basically giving the portfolio a little yield bump without taking on any undue risk. It is a completely lopsided, totally unbalanced portfolio, and it is purely driven by cold, hard data. And the result of that aggressive reallocation? Absolutely stunning. We flipped from a projected $250,000 loss all the way to an expected profit of $265,890. I mean, think about that. That is a massive financial swing of over $500,000. By simply trusting the prescriptive analytics, stepping totally away from guessing on individual loans, and letting the optimization model strictly dictate our capital allocation, we changed the whole game. We took a definitively losing hand and engineered it into a definitive, mathematically sound win. Which brings us right to the final recommendation for the investment committee. Investing in lending club loans absolutely is a viable strategy, but it requires incredible discipline. We can confidently recommend proceeding with the $10 million investment. However, the caveat here is completely non-negotiable. We must strictly use the clustering and optimization model we've just built. We cannot rely on gut feelings, and we absolutely cannot go back to picking individual loans. We have to rigorously filter out those high-risk borrower profiles entirely. They get exactly 0% of our capital, no exceptions. Now, what's really interesting about this slide is how it perfectly summarizes our entire journey today. The data proves that in this market, avoiding the worst loans is far more profitable than trying to pick the absolute best ones. It is such a profound shift in mindset, isn't it? I mean, we spent the beginning of this explainer trying to build these complex models just to pick winners, and we learned pretty quickly that's a fool's errand. True profitability in this high-stakes environment doesn't come from a crystal ball. It comes from macro-level, highly calculated risk avoidance. It comes from identifying the toxic elements and just coldly cutting them out of the equation. So I'll leave you with this thought. Look at your own business, your own investments, or even just your daily decisions. Are you wasting a ton of energy trying to pick the absolute best option when maybe you should really just be systematically filtering out the worst?